Good evening, guys. Okay, so we are going to start. Today we are going to talk about the Indian financial system, banking and stock markets. If there are any problems during the discussion, please put your comments in the chat box so that we can address the issue before moving on. Is that clear? Okay, so let's start. So when we say financial system, a financial system consists of many different components. A financial system consists of financial markets, consists of financial institutions, consists of instruments and services. Okay, I'll explain all of them in due course, but these are the four different components of a financial system. There are regulators in these markets. For example, SEBI, the Securities Exchange Board of India, is the regulator of the Indian capital market, and the Reserve Bank of India is the regulator of the money market in India. Is that clear? Any questions so far? Okay, so let's move on. Financial markets are basically markets where financial transactions take place. Okay, so where buying and financial of securities takes place, those places are called financial markets. Financial markets are typically money markets or capital markets. Money markets deal with short-term debt instruments, whereas capital markets deal with long-term equity as well as debt. Okay. Financial markets are of two types. Financial markets could be primary and secondary. This is true for both money markets and capital markets. Primary markets are those where initial issues of securities takes place. So when a security, for example, a share of a company hits the market for the first time, it is called a primary market issue. And where the issue has been traded earlier, it has been bought and sold earlier, it is called a secondary market. So these are financial markets. Is the example clear? So yes, IPOs are examples of primary markets. So when a company makes an initial public offer, it is part of a primary market. And if it is already trading, people are buying and selling securities, so then it is called the secondary market. Okay, to answer the question which has just been raised, secondary market is for trading of securities between existing holders of securities. So if I have, let's say, a share of a Reliance company, I can sell it in the exchange. In that sense, secondary market doesn't directly help a company. So Reliance will not directly get affected if I buy or if I sell a share of Reliance from another holder. But Reliance can also buy the shares from me, so which are called buyback transactions. Okay, so Reliance can enter and trade in the secondary market also, but that generally doesn't happen too often. Is that clear, Rahil? Okay, so to answer the second question, short-term debt instruments are those like bonds. So when a bond is issued for a period of less than 1 year, it is called a short-term debt instruments. I'll talk about buyback options in a minute, but let me first explain another query which has been raised earlier. Okay. So again, money market and capital markets are different. Money markets are where short-term debt instruments are traded, and capital markets are those where long-term equity and long-term debt instruments are traded. Okay, is that clear? So any instrument which has a maturity tenure of less than 1 year is called a short-term instrument. Any instrument which has a maturity tenure of more than 1 year is called a long-term instrument. So by the nature of equity is always a long-term maturity. It is always traded in a capital market, whereas bonds can both be traded in a money market if they are short-term of less than 1 year, and bonds can also be for a longer tenure and then they are traded on the capital market. Is that clear now? The difference between money markets and capital markets? Okay, so now let me move on to the next query. In a buyback option, a company will buy back the shares from the general public only under certain conditions. Okay, this may happen when the company wants to regain a majority control of the company, or it may happen when the company has some duress. Okay, I would like to go into this detail in the case of buyback a little later. If you could hold back, we will talk about buybacks in a little bit of time. Okay, let me address the next query now. Okay, so if a company is issuing bonus shares or is issuing additional shares from their existing quota, for example, a company has already got shares trading in the stock market and it is issuing fresh shares, it is also called a primary issue. Okay, it is also called a primary issue. It is called an FPO, a follow-on public offer. So when we say, if you're asking about day trading, Tarun, when we differentiate between money markets and capital markets, we are not talking about the tenure of the trade. So if I buy and sell securities, the tenure of my purchase or sale doesn't matter. What matters is the life of the instrument. So if I am, let's say, buying a share today and liquidating it on the same day, selling it today itself, but if the tenure of the instrument as it is printed is for greater than 1 year, it will still be traded in the capital market. So the tenure of the instrument differentiates money markets and capital markets. Tarun, is that clear? Okay. So again, I'll talk about FPO. So somebody had asked me, I think, so Satya had asked me about additional shares. So I was trying to explain that if, for example, a company has already got shares trading in the stock market and it wants to issue additional shares, that fresh issue is also part of the primary market. At the same time, it is not called an IPO because not the initial offer from the company. It is called an FPO, also called a follow-on public offer. It is part of the primary market. Yes. Can we move on? Okay, great. Let's go on. Similarly then, we have financial institutions. These are the institutions which deal in financial instruments. Okay. Primarily, if you understand financial institutions, most of the time people will be talking about banks. Okay. So insurance companies, mutual fund companies, non-banking financial companies. You might have heard of a term called NBFCs. All of these are the financial institutions which operate in any economy. Okay. It could even be industrial or trading companies. It could be individual investors. These are the financial institutions. So generally when we say financial institutions, we talk about banks, insurance companies or mutual funds. Clear? Okay. And then of course we have financial instruments. Okay. Instruments are the securities that I was talking about earlier. These could be equities, so which is shares. It could be bonds. It could be deposits or loans in the case of a bank. And it could be mutual fund units in the case of a mutual fund company. Okay. So any of these instruments which are used for buying and selling financial instruments, the name of these instruments could be deposits, could be equities, could be loans, could be mutual fund, etc. These are financial instruments. Okay, let me address the queries one by one. So a bond is a debt. It is a debt instrument which is issued either by the government or in some cases even by companies. It is like a fixed deposit of a bank. Okay, understand it like a fixed deposit of a bank. It is a debt instrument where the borrower is paying or is promising to pay back the principal plus the interest on that instrument after a fixed tenure of time. Okay, so that is a bond in a very briefly. Generally, bonds are issued by either the government of India or the public sector enterprises or even in some cases by private corporates. Treasury bills are short-term bonds issued by the government of India. Okay. Now, as far as overdraft goes, overdrafts are limits, borrowing limits generally given by a bank to a depositor over and above the deposit available in the borrower's account. So, for example, if I deposit 1 lakh rupees in my savings account in a bank, if the bank allows me to borrow 1 lakh plus some money, so it's suppose the bank allows me to borrow or take out 1 lakh plus another 20,000 rupees. That additional 20,000 rupees which I'm allowed to take out is called my overdraft limit. Okay, so let's talk about next. Can everybody hear me? I think there are some people having problems with the audio. Okay, so let me address the next query. Just let me take up the queries, guys. Then I'll come to your query also. Okay, so we've talked about bonds, we've talked about overdrafts. Let's talk about KVPs. KVP is an instrument issued by the government of India. It is also called the Kisan Vikas Patra. It was actually an instrument issued earlier. It was stopped for the time being and it has just been restarted by the NDA government a couple of months back. Okay, it is an instrument where you can, it is also a debt instrument. You can actually lend money to the government of India if you buy Kisan Vikas Patras. So this is also a debt instrument. The face of the instrument will have a value attached to it. It will have a period attached to it and an interest rate. Okay. So it is called the Kisan Vikas Patra. Okay. And it is when you are, it is like giving a loan to the government of India. Yeah, it has just been started a couple of months back by the government. It promises to double your money within a period of 8 years and 7 months. Okay. So let me move on to the next query. Okay. So what is a treasury bill? Treasury bill is a short-term debt instrument issued by the government of India. It is also a debt instrument. So all of these instruments, whether we say bonds, whether we say treasury bills, these are all debt instruments. Okay. So you finally, I hope everybody understands the difference between equity and debt. Equity is a sense of ownership. So when I buy equity, I'm actually becoming the part owner in the company which is issuing that equity share. And when I'm buying a debt instrument, I'm actually giving a loan to that, the borrower. So if it's the government of India, I'm giving a loan to the government of India. So whether it is the KVP or it's a treasury bill or it's a bond, all of these are debt instruments. Okay. So the treasury bill is also a debt instrument. It is issued by the government of India. It is for a short period of time, less than 1 year. Okay. So let me just see what's next. Okay. So we've talked about PPF and KVP. Okay. What's any other query? Let me just check out if there's any query pending. Then I'll move on. Okay. So PPF. PPF is the Public Provident Fund. It is a fund again where you can invest in, and it is a loan which you give to the government of India. It is a joint, it's a public pooled provident fund. So if you work in a company, every company has an employee provident fund. It is valid. It is a provident fund where you can pool in your money and you get it either on the maturity of that provident fund, or when you leave the company, you can choose to withdraw money from the provident fund. But that employee provident fund is only for the employees of that company. But in the case of public provident fund, any individual can go and open a public provident fund account and give the loan in a pooled way. So people pool their money and give the loan to the government of India. It is also another form of a debt instrument issued by the government of India. Yes, the PPF tenure is initially 15 years and can thereafter be extended in tranches of 5 years. Okay. I'll come to the difference between mutual funds and equities a little bit later when we talk about the stock markets. Then we'll talk about mutual funds and equities. Let me address queries at this stage only related to the instruments. Okay, so we've talked about PPF. Let's see what else is there. See, debentures, if I think somebody has asked me what a debenture is and how is it different from debt. See, a debenture is also a form of debt, but the only difference is that a debenture is a debt instrument generally issued by private corporations. Okay, so it is also a form of debt which private corporations can take from the general public or from other private corporates, and it is also a form of debt. Okay, so all these come under the category of debt. Okay. Now, so the difference between a KVP and a general government bond is that the government does not keep its bond open throughout. So there are bond issues which the government does for a specific short period of time, and then it closes the issues. And those bonds have specific tenures. You can invest in a KVP up to a specific limit anytime during the year throughout your life. So you want to invest for 15 years, you want to go on 1st of April, or you want to go in July, or you want to go in December, you can invest in a KVP up to 1.5 lakh rupees for the entire year. Okay, while a bond issue is only for a specific period of time. Okay, both of these are debt instruments. In both cases, the money goes to the government of India only. Okay. Okay, so I think Sadhvi is asking what exam is this important. Sadhvi, I think your knowledge of financial instruments and financial markets is important not just for any specific exam. It is also going to be important in every interview. So if you tell the panelist, I have no idea what a mutual fund is, or what equity is, or how the stock market functions, you will not look like an average 21 or 22-year-old in any interview, right? So you need to know these things for any interview, not just any exam. Okay, so let's say, so Satya is talking about SIPs. SIPs, as Abhijit has correctly pointed out, are the systematic investment plans. These are terminology used in the case of mutual funds. And again, I will talk about mutual funds when I come to the stock markets. Okay. Any other questions on this slide? Any questions? Okay, moving on. SIP is, well, yes, in that sense, like an RD only, but I'll explain the differences and the similarities in some time. Okay, so SIP is, yes, in that sense, somewhat like an RD. So financial services, what all can you do with the financial instruments? You can buy and sell these securities. So the debt instruments as well as the equity instruments, you can buy and sell them. When we talk about foreign exchange, we talk about something called payments and settlements. I'll again talk about foreign exchange in some time. It's not something I'll touch with right now at this stage. Borrowing and funding, lending and investing, these are all the activities which banks and even merchant banks do. Okay. So this is the activities you can do. These are the services which banks and other financial institutions offer. Okay. So merchant banks, like I was saying, is a type of a bank. It is a bank which does the basic borrowing and lending, but it also does a lot of advisory services. Okay, it takes equity in corporations. So for example, I have a merchant bank. I not only borrow from public, I also lend to public. In addition to that, I do advisory services for corporates, and I also sometimes pick up equity ownership in corporations. So merchant bank does a whole host of services in addition to normal borrowing and lending which a general bank does. Okay, I'll talk about credit rating now. So credit rating is a rating agency function. So for example, you might have heard of CRISIL. CRISIL is a credit rating agency firm. It does credit ratings or financial borrowing worthiness of corporates and individual borrowers. Okay, so CRISIL, CARE, ICRA are all examples of credit rating agencies. So these are also functions and services which financial institutions provide. Yes, at the global level, you have companies like Standard & Poor's, even Moody's, which do these things. Leasing and hire purchase are generally activities which you see more often in businesses related to either transportation or heavy machinery. So for example, Go Air, or let me be more accurate, Indigo has just leased some aircraft from Boeing. So what is happening is that they are going to operate these aircraft. They have paid some money. It is like a rental arrangement. Okay. and over a period of time they will keep on paying a rent for using this aircraft, and after a period of time, as per the agreement, the aircraft will automatically get, the ownership will get transferred to Indigo. Yes, so leasing is that kind of an arrangement. Let me just address some queries which have come up. Okay, so if inflation, so Rahil is asking me about KVP and the inflation connect. Rahil, in case inflation stays at 10%, okay, why KVP? All the instruments, whether it is a bank fixed deposit or even any of the bonds, all lose their real return value. So real return goes into negative territory. Yes. Okay, let me just repeat leasing. I think Lakshay has missed out what is leasing. Leasing is an arrangement. For example, I had given the example of Indigo Airlines. So let's say Indigo Airlines goes to Boeing and asks Boeing, I want to lease some aircraft from you. So they can do that. Boeing will, let's say, give a 10 aircraft to Indigo, and as per their mutual agreement, they will decide that Indigo will pay some monthly rent or a periodical payment for using these aircraft. That periodical rent or that periodical money has to be paid for a certain period of time, let's say 10 years, 20 years, after which the aircraft automatically get transferred to Indigo. So while this 20 years is going on, the aircraft ownership remains with Boeing, Indigo is using them and paying some rent. After those 20 years are up, the aircraft automatically ownership gets transferred to Indigo. So that concept is called leasing. Okay. Generally in land, for example, if you are aware of how property transactions take place, a lot of times properties, especially commercial properties, are leased. Okay, so there's a 99-year lease. Some of you might have heard of that. Okay, so that is what leasing is. Let me talk about then the next query which I'll address. So Soumik, investment banking is something I'll address in a few slides down the line. Please hold this thought. I'll come to investment banking a little later. Okay, recession in Eurozone and US. See, we will have these sessions on economic concepts also, but from today's point of view, I would like to restrict to financial institutions and financial markets, because the area that we have to cover today within financial services itself is too wide. So definitely we'll talk about the Eurozone and US also, but Balkesh, if you could give me time till next time for that. Okay. Okay, so let me handle the next query now. Yes, so Sadhvi, the ownership of the land gets transferred after the lapse of the tenure, and generally these agreements work like this, but still you need to be specific to every agreement to understand the terms of that agreement. So agreement terms can be little bit up and down, but generally lease agreements work on this basis. So after 99 years, the agreement will tell you whether the land will automatically get transferred to the lessee or the lessor will again have the control of the land. This is as per the agreement. Okay, let's go on. Can we move on to the next slide? So let's talk about banking then. So first part of our financial services and financial spectrum is banking. I'm sure all of you know that banking is the business activity whose primary purpose is taking money as deposits and giving money to entities and individuals as loans, right? The bank earns a profit by something called a spread. So let's say a bank borrows money from you. When you put your money in a savings bank account, you put it in at 4% rate of interest, and similarly if you put an FD in a bank, you put it at 8% rate of interest. So the bank gets your money and lends it to somebody else and lends it at 10% or 11% or 12%. So the difference between that 11% and the 8% at which it has borrowed is called a spread. This is the profit which a bank makes. The difference between its lending income and its borrowing cost. Okay, that is how the main function of a bank works. So primary functions, like I told you, the primary function of a bank is borrowing money and giving loans, accepting deposits, granting loans. Accepting deposits, how? You can accept deposits through savings accounts, through fixed deposits, something called a current account, and even something called an RD. One of you had raised a question regarding RD earlier. I'll talk about RDs now. So everybody is aware what a savings account is. I'm sure all of you have a savings account. Okay, great. So I don't need to explain that. The main key differentiators of a saving account from the rest are: one, generally for a saving account you need to have a minimum average balance which you need to maintain in a savings account, number one. Number two, there's a rate of interest which you get on the money that you keep in a savings account, right? That's the main identifiers of a saving account. It is meant for individuals. The second is a fixed deposit. Balkesh, I'll come to this correlation in a couple of minutes. I'll come to all these things which you are talking about, but give me a couple of minutes. Let me just explain the four terms first. Fixed deposit is a deposit. I'm sure all of you again would have it, or would your families would have done it for you. Fixed deposit is a type of a deposit where the deposit is done for a fixed tenure. It is generally at a rate of interest which is higher than the savings account, and you get your principal amount plus the interest amount at the end of the tenure. Fine. Now coming to current account. Current account is an account which is generally meant for business purposes. So people who are businessmen or companies, they open current accounts. The purpose of a current account is to enable a higher number of transactions, which is generally characterized in a business. It is also a zero balance account, so the current account holder need not maintain any balance, any minimum balance in his account at any time. At the same time, the balances which you do maintain in the current account don't attract interest. So you don't get any interest in a current account, and neither do you have to keep any deposit also. It is meant for business purposes so that multiple transactions, high volume transactions can take place for a business. So that is a current account. Is a current account clear? I'll come to all your queries one by one, but first please tell me if current account is clear. Okay. Then I'll talk about recurring deposit. Recurring deposit is a type of fixed deposit. In this, unlike a fixed deposit, you don't have to give a lump sum amount upfront, and that lump sum amount is locked in for a fixed period of time. In a recurring deposit, let's say you don't have 1 lakh rupees on day one, but you get a salary and out of which you save 5,000 rupees per month. That 5,000 rupees you can put in a recurring deposit, and every month thereafter for a fixed tenure you keep adding 5,000 rupees to that deposit. At the end of the tenure you get your 5,000 rupee principal amounts plus the interest accrued on that, right? So it is a type of fixed deposit. The only thing is you don't have to give a lump sum amount to the bank initially. On the other side of the picture, you have, okay, so Manjeet is asking me if I don't add every month. So in that case, generally every bank will either give you a window. So they'll say, okay, so there's a certain period of time. So you need not add only on the first of the month. So they'll allow you a certain leeway. They'll say, okay, so you have a week to deposit this amount. In case you don't, the deposit will continue to run, but will only add interest on the amount which you've already added. Okay, so then in that sense, it will become a general fixed deposit. Okay, interest earned on a fixed deposit can never be equal to an interest earned on an RD, Harman, because in an RD, the amount is not paid on the first day itself. So therefore, if I pay on 1st January 2015 5,000 rupees and the period is for 1 year, I'll earn interest for 1 year only on 5,000 rupees. The first the 5,000 rupees which I deposit on 1st of February, I'll earn interest only for 11 months. Similarly, if I deposit 5,000 rupees on 1st of March, I'll earn interest for 10 months. So that's how it works. Whereas if I deposit 60,000 rupees on 1st of January, I'll earn 60,000 rupees interest for the whole year. So the interest on an RD for the same tenure can never be the same as an FD. Okay, so that is the difference between an FD and an RD. Let me quickly come to the other side and then I'll talk about your queries. So the other side is the loan side. These are the loans which a bank gives to customers, and there are different types of loans. Actually, this is just an indicative list. There are many different types of loans which a bank gives. Cash credit is a business transaction limit. It is a limit. It is given to a bank for working capital purposes, right? So a bank gives this limit to business people for the purpose of their working capital or everyday requirements, operating needs. Bank overdraft and loans are similar in the sense bank overdraft is, like I told you earlier, if I deposit 1 lakh rupees and the bank allows me to withdraw 1,20,000, they do it against some security, obviously. That is called a bank overdraft. And then you have loans. Now loans is like a fixed deposit or the mirror image of a fixed deposit. Loans is when a bank gives a fixed amount from day one for a fixed period. So let's say the bank gives me a personal loan or a car loan for 1 lakh rupees for a period of 3 years. And they tell me how the repayment has to take place. That is a loan. But in a bank overdraft, the bank allows me to draw. If I have deposited 1 lakh rupees, the bank allows me to draw or withdraw 1,20,000. I may or may not withdraw it. Interest is charged only if I use that overdraft limit. But on a loan, if you take a personal loan or a car loan, interest gets charged from the day you take the loan. Discounting bills is, for example, there are two corporates, corporate 1 and corporate 2. So let's say corporate 1 sells a tire. Let's say a tire making company like Apollo Tire sells its tires to Maruti for using in their cars. So Apollo Tire gives Maruti a bill for, let's say, 10,000 rupees. It has sold tires to Maruti and it gives a bill to Maruti for 10,000 rupees. Now Maruti has got the bill, right? And Maruti says, I will pay you after some time. That can happen as per the business arrangement between the two parties. So then Apollo Tires can take a copy of the bill and come to the bank and say, I have got to take this money from Maruti after 3 months. Please discount this bill and give me my money right now. So bank generally can do that. It can discount bills. It is also called factoring. Okay. But I guess for the purpose of this class is only an introductory class. You need not go into the details of bill discounting and factoring. Okay, so let me come to your questions now. There are a lot of questions. So please pause for a minute. Let me address all the questions and then I'll move on. Okay, so Balkesh is asking me, okay, I guess the cursor keeps on moving. Guys, if you can stop typing for a minute, let me address the queries. And then if I ask you any questions, you can type at that moment, right? Because the cursor keeps on moving if you keep on typing. Okay, so Balkesh is asking me, so if you deposit money in a bank and the bank lends it, right? So let's say I deposit money in a bank, 100 rupees in a bank, and the bank lends it to somebody else. And if I go back to the bank to withdraw my money, now the bank doesn't have the money. Balkesh, we'll talk about something called cash reserve ratio and statutory liquidity ratio in some time. And then I'll explain the concept of how banks keep some money with them so that people who want to withdraw, they can withdraw. So I'll come to that in a couple of minutes, Balkesh. If you don't have an audio, please try logging in again. Yeah, let me just address the queries which have been raised and then you can type your queries further, okay? Okay. So Simar, the minimum balance in an RD, I believe that's what you're asking me. This is bank specific. Every bank decides their own policy. Banks even start at 500 rupees, even 100 rupees RDs you can open in some banks. but generally it's 500 or 1,000 or 2,000 rupees with most banks. Okay, the minimum amount which you can put in a RD. So if you're asking me about a savings deposit, well, again it is bank specific. A savings account average balance requirement differs from bank to bank. Every bank has their own set of requirements. Okay, so that is about a savings deposit, Simar. Vaibhav, credit cards are the secondary functions. I'll just talk about them in the next slide. Vaibhav, if you could just hold on till the next slide, I'll talk about how bank makes money from credit cards. Okay. So you can withdraw money from a fixed deposit, Rahil, but at the same time the bank will charge you a penalty because the bank has taken the money from you from a fixed tenure, and if you borrow the money or take back the money against without completing the tenure, the bank will have some penal interest levied on you. Okay, so they will have some penalty. They will not pay you the interest which was promised. For example, if the FD which you have done with a bank is for 1 lakh rupees at 8% per annum for 1 year, and you withdraw after 6 months, the bank will not pay you your 4,000 rupees. You understand the calculation? For example, it's 1 lakh, 8%, so you would have got 8,000 after a year, and in half a year you should have made 4,000. They won't pay you 4,000. They'll have some penalty clause, and where they'll deduct some money for the early withdrawal of money. So banks will generally will generally have a penalty, but it is specific bank to bank. Okay. Okay. So let's see what else is there. So again, I think Daksh has asked me, how does a bank gain by the cash credit route? Cash credit is a limit, a borrowing limit which a bank gives to corporates for their working capital requirements. Okay. In fact, all of these limits, whether it's an overdraft limit or whether it is bill discounting, generally banks give to corporates only, and corporates are able to manage their day-to-day operations thanks to these borrowing limits. Okay. The reason why bank gives this is that because borrowers are generally short of funds. The borrowers, when I say borrowers, I mean the corporates. And when they borrow this money, they can use it in their day-to-day operations. How the banks are secure is because they have some form of security which they take from the borrower. They will generally take some property or the plant and machinery of the borrower, or even the stocks, the inventory of their business as the security, so that the borrower, in case there is a default or the borrower can't pay back, like Kingfisher Airlines, they have something to fall back upon. Okay, so that's how cash credit works. The borrower borrows money, the bank earns money because of the interest which they charge, like I told you earlier. So all of the instruments on the right side, the bank will charge interest. All of the instruments on the left side, the bank will pay interest. Okay, except the current account. Okay, let me just see what are the other queries which I have missed out. Guys, any queries which I missed out, please type them now. Any queries still pending in your mind? Okay, so overdraft versus cash credit. So Pratik, overdraft, like I said, is a limit over and above some deposit which you've already placed. So I need to first place a deposit, and let's say I have a deposit of 1 lakh rupees. The bank can allow me to withdraw 1,50,000 provided I give him some other security to the bank. So that's called a bank overdraft. The cash credit, I don't need to deposit anything. The bank will give me a borrowing limit without my depositing anything. Again, there is a security which is involved. Okay. Ripudaman, bill discounting works like this. So let's say, suppose, like I give the example of Apollo Tyres. Apollo Tyres is selling tires to Maruti for using in their cars. Apollo Tyres sells tires worth 10,000 rupees to Maruti. Apollo Tyres has a bill. It goes to Maruti. Maruti says, I'll pay you after 3 months. I'll not pay you right now. That can happen, right, in business. And then Apollo Tyres needs the money right now. Apollo Tyres goes to its bank, and Apollo Tyres says, this is a bill, or this is a copy of the bill. I've sold tires to Maruti. Please pay me the money right now and collect 3 months later from Maruti. So what your bank will do, bank will pay 9,000 to Apollo Tyres and cut 1,000 as their margin or their income. And at the end of 3 months, the bank will go to Maruti and get 10,000. So that's again how the bank earns. It pays 9,000 to Apollo Tyres so that Apollo Tyres gets the money immediately on day 1. And after 3 months, the bank gets 10,000 from Maruti. Okay, so that's how a bill discounting transaction works. Yes, what else? Okay, in case Maruti defaults, I can always go back to Apollo Tyres. Like I said, all the instruments on the right side, I will take a security from the borrower. So when I give 9,000 to Apollo Tyres, I just don't give it like this in front of the bill. I take some security like the inventory of Apollo Tyres or the building, plant and machinery, land of Apollo Tyres as security. So I can always go back to that. Okay, so Kingfisher. Yeah, this is a very interesting one. So Kingfisher, the banks have the securities, which is the planes of Kingfisher Airlines. The banks have the security of Kingfisher, the company. So Kingfisher, the liquor making company, they have the security from that company. They can go to that company and demand their money. And they also have the personal guarantees of Vijay Mallya and his family. So they can go to Vijay Mallya's house, knock on his door and ask for their money. So the banks are currently in the process of collecting their money or trying to see how much money they can collect from all of these securities. So the banks can do all of these things. Okay, so that's what they've done in the case of Kingfisher. Okay. Yeah, Apollo Tyres does lose 1,000, but then Apollo Tyres needs the money up front, no? So any loan that you take from a bank, you always pay interest, right? So it's not a loss, it's an interest cost. Okay? So Harman, it is something which the borrower will see as an interest cost. If I were ready to get 10,000 rupees after 3 months, I would have waited. I needed the money today. That's why I went to the bank. So I paid 1,000 rupees as interest. That's how it works. Okay, what else? Anything else? Any other query, guys? This slide. Can we move on? Okay, so again, cash credit versus overdraft. Cash credit is a form of loan or a borrowing which I can give to a corporate. It is without a balance to be kept by the corporate. It is a working capital limit. Okay, it is also called a working capital limit. Basically, I give a borrower, a corporate borrower, a borrowing limit so that he can continue his day-to-day operations. In a bank overdraft, I need to keep a balance, and the bank allows me to overdraw that balance. In excess of what I have kept with the bank allows me to draw the money. And generally, both of them, in fact, all the instruments on the right side are against some security which the bank takes. Okay, so is that clear, Akhil? Okay, so Balkesh, the difference between average and minimum balance, you don't need to worry, because when we talk about balance to be maintained in a savings account, it is always average balance. Okay, some banks also call it the quarterly average balance or the QAB. Okay, so the balance the banks require to maintain, they check it on a quarterly basis. So suppose a bank wants you to maintain 1,000 rupees in its account, in its savings account on an average. So let's say on day 1, you open your account. On day 1, you keep 90,000 rupees in your account. On day 2, you withdraw the 90,000 rupees totally. Your account balance becomes 0. Now from day 2 till day 90, till the end of the quarter, your balance is 0. At the end of the quarter, the bank will calculate what was your sum total of daily balances. And they will find the sum total of your daily balances is 90,000 on the first day and 0 on the other 89 days. So they'll divide 90,000 by the number of days and they'll get 1000 rupees as the average which you have maintained, right? So that is how the average is calculated. They will not give you any penalty for that if you maintained 1000 rupees. Is that clear, Balkesh? Okay, so moving on. So let's talk about the secondary functions. The secondary functions can be either agency functions or utility functions. Agency functions include anything which the bank does as an agent for you. So if you want to transfer funds to somebody, you can do that. Today you can do it even online, but even earlier you could do it by going to the branch of a bank. So you could transfer funds to a person who is having an account in the same bank. You could also transfer funds to people in other banks who have accounts in other banks. They could collect checks for you. They could have payment services. So for example, you want to pay your electricity bill after every month or your water bill every second month. So they can do that on your behalf. They can manage your investment portfolio. That's also possible. And of course, there are some other specific agency functions which they perform. In terms of utility functions, a bank will issue drafts, they will issue checkbooks, they will issue something called a letter of credit, they will issue you lockers for keeping your valuables, they will do something called underwriting of shares. We'll talk about that when we talk about the stock markets. And they will also deal with foreign exchange. They will do project reports, they will do some social welfare programs and some other functions. Okay, so this is what the bank does. The important thing to note is that in the previous slide, which was the primary function, the bank made money by the spread. So the difference between what they earned on the right side and the difference between what they paid on the right side, this was the earning for the bank. But in the case of slide 10, which is the secondary functions, the bank makes money by taking some commission. Okay, so these are commission based services. They will always charge you certain amount of money. It is called commission or fee for all of these services. Okay, so this is how they make money from secondary functions. Any questions here? Yes, so CMS is also a utility function. CMS is cash management services. Portfolio management is a part of investment management. Yes, it is an investment advisory service. We'll talk about that when we come to merchant banking or investment banking. Okay, so how they make money is simple, Abhishek. So when you go to a bank to issue a draft, a demand draft, a DD, they will say our charges are 50 rupees. So that fee or that commission which they charge you is their income. That's how they make money on agency and utility functions. All of these, they will charge you a fee. Okay, it may even be free in case of some banks, but again that is bank specific. Generally banks charge for these services. Okay, underwriting of shares, very briefly, it is a term where banks, so suppose let's say a company is doing an IPO, it is coming out with a share issue for the first time. Okay, so a bank can go to the company and offer to underwrite the shares, which means the bank can offer to give a guarantee. So the bank will say, we'll manage the IPO for you, we'll look at all the administrative issues involved in this initial public offer. In addition to that, we'll underwrite the shares, which means in case people don't buy your shares, we will buy them for you. Okay, so the bank does its due diligence, it does a credit check on the company, and then it can offer underwriting of shares. Again, they charge a fee for this. Is that clear, Akhil? Okay, so Shiv, the amount of fee charged for these services was never dictated by the RBI, but in recent times, RBI has started coming into the picture. In fact, just a few days back, the RBI in discussion with the banks in India, the banking sector in India, has decided to curb the limit on number of free ATM transactions which a person can use in a month. Now, just today, the Delhi High Court has challenged that decision of the RBI. So this decision was to be implemented from 1st January 2015. But the High Court of Delhi today has asked the RBI, how can you do this? How can you say that if I go to my bank and I want to withdraw my money from the ATM, why will you charge me for it? So the High Court has put a question to the RBI. It remains to be seen how RBI responds, but that the RBI is entering into the fee related questions these days. Any questions? Can we move on? Okay. So going on. We've already discussed this. The last one, the no frills account, is a zero balance account. Generally, some banks were offering this earlier also, which basically means it's a type of savings account without the deposit requirement, without the average balance requirement. So a depositor who's opening a savings account, an individual can open an account without having an average minimum balance requirement. It is called a no frills account. Some banks were offering this earlier. In fact, when RBI talked about rural banking and going into primary sector lending, banks used to give this account, but now thanks to the Jan Dhan Yojana, which the NDA government has launched, there are no frills accounts being offered by every bank today in India, which means an individual investor who wants to open a bank account can do it without any average minimum balance requirement. So I don't need to keep any balance in the account. I will not be penalized at all. Okay, so that's a no frills account. At the same time, why it is called no frills is because I will also not get any free services. See, generally how a bank works, I mean, it is logical to assume this. A bank will ask you to keep, let's say, 1000 rupees in their savings account as an average quarterly balance. Why they do it? Because they will pay you only 4% on that, and with that 1000 they'll invest it somewhere else and earn maybe 10% or 12%. So they earn some money on your saving account balance. But in a no frills account, they earn nothing because you keep nothing in the account, so they earn nothing. So in a normal savings account, because you're keeping that 1000 balance, generally a bank will give you some services free. Like for example, your checkbook will be free, because the bank is earning something from your saving account balance. But in the case of a no frills account, since they are not earning anything because you are not keeping any balance, so therefore no services will be free. You will be charged for each and every service also. That is why it is called a no frills account. See, Abhishek, they don't pay you interest because you don't keep a balance. If you were to keep a balance, they will pay you interest. No frills account is a type of saving account only. Any balance maintained in a no frills account will attract 4% rate of interest. Salary account is also a type of saving account. It is all the individuals. I didn't get your question, Abhishek. What is the use for me? I didn't understand. Okay, so what is the use for you as a depositor? So the idea is you're asking about a no frills account, right, Abhishek? You're asking about the no frills account? Okay. So you will open the account if you don't have 1000 rupees to maintain as an average balance. For a poor person, somebody who is not very well off, doesn't want to keep his money idle. He doesn't have the kind of luxury to keep 1000 rupees in his account balance, right? So therefore it is for the people who are either very poor or who don't want to keep money in the account. They don't have that kind of money. So for them, the no frills account is very important. Of course, so when you open a no frills account, Shiv, it means that you don't have to mandatorily keep an average balance, and therefore the account, see, understand how it works. I am feeding in to my software certain instructions. So if you open a no frills account, the set of instructions related to charges are already fed in. So whether you all keep a balance or not, the system doesn't recognize that. The system just recognizes what to charge for and what not to charge for. Right? So Shiv, the system will not be able to differentiate whether you've kept zero balance in no frills account or 1 lakh rupees. The system will just know that you've taken a checkbook. The already fed in instructions are to charge 100 rupees for a checkbook. That's how it works. So in a no frills account, no matter, even if you keep a balance, you will be charged for the services. Any questions, guys? Okay, moving on. So in India, the banking regulator is the RBI. The banker, it is the banker to the government of India, as well as the regulator of the banking sector. Okay, so Balkesh, fine. Okay, good. Good, you have some enlightenment. So RBI is the banker to the government of India. It is also the central banker, the regulator of the banking sector in India. Okay, it makes the policies for the banking sector. It regulates whether any policies are being violated. It also levies penalties on violating banks. So it is the rule maker as well as the watchdog for the banking sector in India. Then there is a term called nationalization, okay, which means that in 1969, as per the policy of Indira Gandhi, there were 14 banks which were nationalized, which means these were private banks. They were converted to public sector banks or government owned banks by the government at that time. This process was called nationalization. So these were private banks. No, this was done at the time of Indira Gandhi. Okay. And then again in 1986, other banks were converted from private banks to government banks. So how is it done, Balkesh? It's very easy, yeah. I mean, if you look at Air India today, I don't know if you know this, but the Air India was started by J.R.D. Tata. It was not a government organization. It was a private airline. But the government said, wait, I want to run this because I want a government airline to be there in India. So the government can do that with any private corporation it wants to, it can nationalize. Okay. So the government can take the ownership, it can pay the private entrepreneur and tell him, please go away, the company now belongs to me. So the government did this with the 14 banks in 1969 and again with 6 more banks in 1980. So the reason why it was done was to ensure that these banks not just function for profit, but in addition they do work for social welfare. So they go to unbanked areas. For example, you might be knowing that in rural areas in India, you have money lenders who charge exorbitant rates of interest. So the purpose of nationalization was that these banks should set up branches and offices in even rural centers where they might not make huge profits, but they would serve the poor. So social welfare was the purpose behind nationalization. Okay. Yes, so the ownership is transferred by paying off the entrepreneur and buying his ownership stake. That's how nationalization is done. Well, forcefully, well, that's a nice way of saying, well, you have to do it, right? If the government asks you to do it, so whether you call it forcefully or whether you call it by coercion or whether it is by agreement, either ways you have to do it, right? So after 1980, none of the banks have been nationalized. Okay. So there is no recent instance of nationalization in the last few years. Okay. Within a bank, you have different verticals. Okay. And this will be interesting for the people who plan to work in a bank after completing their MBA. If you want to work in a bank after completing your MBA, you could get a job either in retail banking, business banking, private banking, and some of you might even end up in investment banking. These are all verticals within a bank and you could end up in any of them. So retail banking is the one which you see every day. I'll come to the price of nationalization. I'll come to all your other queries. Let me just finish off the slide first. Okay. So retail banking is the banking which you see every day. This is the system which works in the branch of a bank. So when you go to a bank, either to deposit some money or withdraw some money, or let's say you have a check deposit or a demand draft to be made, all of these functions where individual borrowers and lenders are catered to, this is where the retail banking operations of a bank. Business banking, like the name suggests, deal with the businesses. So when a bank's customer is a company, it goes to the business banking team. Okay. Private banking is when we make investments for individuals but who are high net worth individuals. So people who want to invest in mutual funds or insurance or in equity, and they want to invest large amounts. Okay, private general banking applies. Private banking is the function who takes care of rich individuals and their banking needs, whereas investment banking talks about investment related needs of companies and organizations. Okay, so that's the branch of a bank, or that's the vertical of a bank which deals with this. Okay, let me now talk about your queries. Okay. Yeah, so government buys the ownership and therefore it buys the corporation and it is called nationalization. Okay. Okay. Some of you seem very shocked that nationalization, how you can just take a private company. But the government can do that, yeah? Government can do anything. Okay. Okay, so Basel norms, Daksh, are something which I will not touch today. It's a very important topic for sure. But Basel 1, Basel 2, Basel 3 are norms which I would like to explain in detail. And we'll talk about this in the detailed banking tutorial. We have a tutorial on banking in detail. We'll talk about Basel 1, Basel 2 and Basel 3 during that. Okay, Basel something is that I will not touch today. It's something which is quite extensive. Okay. Price of nationalization is decided by the government, yeah. So the government decides how much it wants to pay. What is the right amount of money to pay? It can pay nothing also. If the government decides that this business is something which they don't want to pay for, this only happens in extreme situations. It has never happened in India, but the government is free to do that. I mean, it can nationalize without paying anything also. Okay, so that's fine. That they can do that. Okay, so investment banking deals with investment related financial needs of corporates and organizations. Okay, so Rahil, large individual investors also come within the investment banking ambit, but generally it's organizations and corporates that we are talking about. Okay, so investment banking deals with that. I'll come to that in just a minute or just about 5 minutes. Okay. Nationalization in the US, it has not happened in recent years. I'm not aware of any instance in recent years, but it has happened recently, or not recently, but a few years back in Cuba, where US sugar companies or companies which had American sugar companies which had set up mills in the Cuban country were asked by the government, Cuban government, to go out. The Cuban government said we are going to nationalize these sugar factories, and the Cuban government did that. They didn't even pay anything. So it has happened. It has happened in other countries also, but I'm not aware of a case in the US. Okay. Okay, so business banking. Business banking is a case where, for example, we talked about cash credit, we talked about overdraft, we talked about loans. Business banking deals with all the banking needs of a corporate which are of non-investment nature. So corporate wants to give a deposit or the corporate wants to take a loan, business banking will deal with it. But if the corporate wants to make some investments, for example, the company wants to invest in the share market, or company wants to come into the IPO, then the investment banking team will deal with it. Okay, so that's how it works. Yeah, so can we move on? Okay. Four types of banks operate in India, as you know. Of course, there's the RBI, and there are four other types of banks. You have commercial banks, you have local area banks, you have cooperative banks, and you have development banks. I'll explain each one of these in the upcoming slides. Okay, so let's start with the central bank. Central bank, like I told you, is the Reserve Bank of India. It was established on the 1st of April 1935. It is headquartered in Mumbai, and like I told you, it is the regulator and the supervisor of the financial system. It is also the monetary authority. It makes something called the monetary policy. Some of you might be aware that the monetary policy is announced by the RBI every quarter. It also manages foreign exchange regulation in India. It issues currency, and it does development as well in the financial sector in India. Okay, so this is the key functions or the key roles of the RBI in India. This is clear? I guess this is very simple. So the currency is also issued by the Reserve Bank of India. If you look at the currency note, any currency note which you might have in your pocket right now, the note has a text. Okay, the note has a text. Actually, a rupee note is also a kind of a debt. Okay, so it is a debt instrument where the RBI promises to pay the holder of that instrument some money's worth. So if it's a 10 rupee note, the RBI will say, I promise to pay you worth of 10 rupees if you give me this instrument. So in that sense, it is like a debt instrument. Okay, so for every issuance of currency, the RBI must have the underlying security. Okay, reserves कहते हैं उसको. It is called reserves. Okay, generally reserves are either maintained in dollars or in gold currency. So either dollars or gold, it maintains reserves for every issue of Indian currency. The RBI can issue unlimited currency. Yeah? How can you? I mean, the RBI is. Like I said, it has to maintain reserves. So if it has dollars, if it has gold, it can issue currency. There's no limit. But of course, some of you might also know that currency issuance also has implications. Currency issuance means or leads to inflation. Okay, so it cannot arbitrarily keep on issuing currency. It has to be realistic. Okay, let me address your issues before I move on. Okay, so in terms of monetary policy, if you look at the Reserve Bank, the ownership of the Reserve Bank is it is owned by the government of India. It is owned by the government of India, but generally the decision making of RBI is autonomous. So for example, some of you who have been following the financial markets would have been aware in the last couple of years, whether it was the UPA government or now it is the NDA government, both governments have been pressurizing RBI to reduce interest rates. But the Reserve Bank has not done that. They have stood by their stand and they are dealing with inflation as they see fit. So in that sense, if you were to look at a clash between the Finance Ministry and the RBI on monetary issues, the RBI is pretty autonomous. Okay. Again, inflation, deflation is something that I will talk about in the economy session. We have another session tutorial on economy. I would love to talk about there because I need to cover some more issues related to the financial system today. But I will be talking about inflation and deflation. Please keep a watch out for this session on the Indian economy. And there we'll talk about these issues. Okay, let me see what else is there. Rajiv, not directly. The World Bank directly does not have any say in the issue of currency. So the World Bank can't tell the RBI, please print some of your notes. They can't do that. No. Abhishek, I didn't understand your question. What is the worth of 10 rupees? I didn't understand. So while Abhishek is probably clarifying, I'll answer your query first. Currency rates, or for that matter any price of any commodity or any product in the world, is decided by demand and supply. So the price of the rupee or how much rupee can buy versus any other currency is decided by the demand and supply of the rupee and the other currency. So let's say if the dollar versus the rupee is 60 rupees to a dollar, this exchange rate is decided by the demand and supply of rupee and the demand and supply of dollar. Okay, that's how it works. Now there are various factors which affect the demand and supply of rupee and affect the demand and supply of dollars. I'll come to that when I talk about foreign exchange management. Okay, but in short, it's always demand and supply. So if India were to borrow money from abroad, whether it is the World Bank or any other organization or any other government for that matter, it can borrow, Indian government can borrow money from the overseas governments also. So Indian government can borrow money from the government of China, for example. It is always against the security of the exchange reserves. So if I have dollar reserves or gold reserves, I can borrow money against those. Lakshay, as I have told earlier, any country can only print money as per the amount of reserves it has, cannot print more than that. Okay. Okay, Rahil, to understand why the dollar is the global currency, actually, dollar is the pivot currency against which all the other currencies of the world are measured, as well as all the transactions of the world, international transactions of the world, are generally denominated in dollar terms. Why this is so is a long story. It happened after the Second World War, and in 1970s, till the 1970s, it used to be gold. International trade used to be happening in gold terms. But in 1971, the US said that we will not take this and we want to have our own independent trading. And primarily because of the weightage of the American businesses. So if you look at the development of the world in the last 60, 70 years after the Second World War, it is the US corporates which have generally globalized and sold their products to a large part of the world. Okay, so they have been the maximum global influence, and because these are American corporations, the trading has happened in dollars. It is purely because of the weight of trade happening from the US. Okay. Yeah, the Bretton Woods Agreement. That's correct. Okay. So Weber, the value of reserves does change regularly, but at any time that the government or the RBI wants to issue currency, it looks at its reserves at that time. Every day the RBI doesn't want to issue currency, right? So at that time when the RBI wants to issue currency or feels the need to issue currency, it looks at its reserves at that time. Guys, any other issue? Okay, moving on. So the next head is the commercial banks. These are all the banks that you see every day in your life. Okay. These are all the institutions that go, let's say, from private sector banks, public sector banks, foreign banks. These are the banks that you see every day in the markets, and you go there, you pay the money and keep it in an account. You take loans from them. These are all those commercial banks. Okay. The regulator is of course the RBI. The first commercial bank in India was the Hindustan Bank, set up in Calcutta in 1770. Okay. Okay. So I'll just have a look at your questions and I'll move on. Lakshay, why would a country want to reduce money in the market? Yeah, why would a country want that? First tell me that and then I'll explain how it is done. Yes, Lakshay, I'm waiting for your response. Okay. So Lakshay, in case the reserves value decreases, the RBI doesn't need to take back the money from the market, but it can. Okay. So we'll talk about measures like the repo rate, reverse repo rate, CRR, SLR in just a couple of minutes, and then I'll explain how money is absorbed away from the market. Okay. So we'll talk about that in just a couple of minutes. Okay. So yeah, so I have a lot of questions on repo, reverse repo. I'll just come to that in a couple of slides. Yes, Balkesh, what is your doubt on reserves? Yeah, please tell me. Balkesh, any doubt on reserves? So like I said, Balkesh, it doesn't have to be gold, it can even be dollars. See, dollars will always be there, no? So for example, if there's an exporter sitting in Bangalore and he's doing some software development, he's selling the software in the US, he will get dollar income. So dollars will come into the country thanks to exports, number one. Dollars will also come into the country when, for example, let's say a Walmart comes and sets up a shop in India. They will bring dollars. So FDI or FII or even exports will bring in dollars. So dollars will be there or gold will be there, and that will be the reserves which the RBI has. So Sadhvi, you want to talk about FIIs? Okay, FIIs are financial institutional investors. These are people who uh, uh, invest in the Indian markets, Indian money markets or Indian capital markets. Okay, so these are people who come into India, invest their money, but they don't set up a business. They invest in the Indian money markets or capital markets. They buy securities. See, Shiv, the reason why any country would want to make transactions in their own currency is always to uh, keep the currency fluctuation risk away. Okay, so for example, I make an international transaction, a foreign currency transaction, and I pay my money, the exchange rate could have moved, and therefore I might end up paying too much, or I might even end up paying too little. So the point is, there is a risk. So I always try and make sure that I pay in my own currency. That's why people or some countries try to make transactions in their own currency internationally as well. Okay, that's how it works here. Yes, any other questions? Okay, so Ripudaman, how FIIs affect the economy? It's very simple, yeah, Ripudaman. FIIs bring in dollars. They invest in the Indian stock markets or Indian money markets. Of course, when people invest, they buy securities, the markets go up. At the same time, the RBI gets its dollar reserves. So in both ways, FIIs and FDI give some impetus to the economy. Okay, so IT sector, if the dollar increase or decreased, will get affected. For example, if the dollar moves from 60 towards 50 levels, my export will become less competitive or more competitive. You tell me. So if I'm making a software sitting in Bangalore, I want to export the software. Let's say the exchange rate is 60 rupees or it is 50. Which is better for the exporter? 50 or 60? Which is better? Please tell me. Okay. So I've got some 50s and I've got a majority of people saying 60. So let me just give you the example a little more detail. So let's say I'm making a software and the cost of making this software is 300 rupees. Okay. When I raise the bill, when I go to my US buyer and I tell him I made a software of 300 rupees, if the exchange rate were 60, I would have made the bill for $5. If the exchange rate is 50 now, I will make the same bill for the same software for $6. So my exports become more expensive. So for an exporter, a cheaper rupee, so that means a rupee which is 60 and 70 and going that way, is always better. Exports become cheaper. Is that correlation clear? So for an exporter, it is always better if the rupee loses value. No. Okay, so I'll explain again. So let's say I make a software. Let me just put it up on the whiteboard. Let's see if I can get it on the whiteboard. Okay. So let's say I make a software for 300 rupees. Okay. So this is the software that I have made. Now when I give this software to my client in the US, I will print a bill for dollar. The exchange rate, remember, is 60. So I will print a bill for $5. 5. Now assume the exchange rate is 50 rupees. The same bill, this again, the same software which I have made here. Now the bill will be $6 because of this exchange rate. Right? So for the exporter, if the exchange rate is this, my sale to my US client becomes more expensive or I become less competitive. Whereas if the exchange rate is this, I can sell my software for $5. It becomes much cheaper for my buyer and therefore I become competitive. So for an exporter, a cheaper rupee, a rupee which is weaker, is always better. Yeah, Rahil, that's the story, right? So it is, well, not sad, but it's the truth. That's how, the mathematics of it works. Okay. So this is about the FIIs and the FDIs. So moving on. So commercial banks, this is just for your information. I don't think I will go into all of these. This is not required, I believe. So commercial banks can be scheduled banks and non-scheduled banks. We will primarily be talking about the scheduled banks. So like I told you earlier, scheduled banks can be foreign banks. So which is your Citibank, your HSBC, your Standard Chartered Bank. These are the foreign banks. You have private sector banks, your ICICI Bank, your IDBI Bank. And then you have your public sector banks, which is your State Bank of India, etc. Right? Yes, Balkesh, so that if my currency is weaker, the Indian exporter is more competitive, maybe as compared to exporters sitting in China and Philippines and other countries. That's how it works. So my exports are more competitive. Okay. So anyways, let's move on. Local area banks, these are basically private sector banks which have been set up by RBI specifically for localized banking. In fact, RBI sets a limit that these banks can only work in a maximum of 3 districts. They cannot extend beyond that. So you have a lot of local area banks, but of course, because they are localized in nature, they can't go beyond 3 districts. You will never hear about them. They will always be more or less quiet and less known to the world. Okay. So these are primarily agricultural based banks. Sadhvi, devaluation of currency I'll talk about when I talk about foreign exchange transactions. Harman, how will the entire world adopt dollar? Yeah, I mean, who will allow that? Can you start printing dollars? I don't think you can. So local area banks, some names, for example, the Krishnabim Samrishi Local Area Bank was the first LAB in India. But like I said, you would not have heard of it because these are very localized in nature. They will never gain prominence. Shiv, I didn't understand your question here. What is your question? Huge influx of currency. Shiv, see, the point is a central bank, and you know what you're mentioning, the question which Shiv is mentioning has happened very recently in the case of Zimbabwe, just a few years back. So where the central bank prints money without having adequate reserves in context of that printing. So that can be done. So there is no authority to check that. The World Bank will not come and say, why are you printing the money? But the idea is generally not done because it leads to an unbalanced situation. You don't have the reserves, the country can go bankrupt. The government can capsize. Okay, so the banking sector can go bankrupt, your money loses value. Right? So at one time, for example, in Zimbabwe, just about 4-5 years back, there was hyperinflation related to thousands of %. Okay, so it generally doesn't happen that the central bank of any country prints money in excess of its reserves. Generally, it doesn't happen that way. Why would the US allow you to have the dollar as its currency? You're not part of the American territory, or you tell the American, or you tell America that you are ready to be part of America. Then it's fine. You can use the dollar. America, you become a territory which is under American sovereignty. Then it's fine. Otherwise, how can you? Yeah, nobody will recognize your dollar as the same dollar, no? So it's not possible to do that. Okay, so coming to local area banks generally do suffer from cash crump, but the issue is that they are generally financed by the central government under some plan outlays. So if local area banks are suffering from some cash crunch, generally in the budget, in the plan outlays, in the planned expenditure part, there will be some money which is allocated to the local area banks. That generally happens. But they do, yes, suffer from cash shortages. They are not very efficient in their operations. Okay. Yeah, Balkesh, so same currency in the whole world. How is it possible unless the whole world belongs to one country? Yeah? See, the idea is that every country will have its own currency because it is distinct from other countries. Right? So if, for example, a guy sitting in India wants to buy and sell products, it has to do it in its own currency. Otherwise, you're part of the same territory. For example, India and Pakistan, unless they have the same, unless they have different currencies, how will you know that they're not the same territory? See, the Eurozone is a result of a set of agreements. Okay, this Eurozone came into place in 1993. The discussion of that had been happening since the last 40 years, even before that. But in 1993, they decided to have agreement. It is called the FTA, Free Trade Agreement, where they said that this entire set of countries, started off with 12 countries, now it is up to 27 countries, these will all have a single currency. Okay, where all of them will have a common set of policies with regards to the rest of the world. They will have trade agreements within themselves, and they will have a common currency, and you will also not have to have a specific approval required to travel between the countries. So for example, people can move freely within the countries falling in the Eurozone. So this is as a result of a separate special agreement. So that can happen, but in that case, there's a specific agreement which needs to take place. Otherwise, it's not possible. Okay, so can you guys hear me? I think Ripudaman doesn't have the sound. Can the rest of you hear me? Nishant, India is already in process of negotiating an FTA with the Eurozone. Okay, yeah. So let me just read out the question which I was answering. So yeah, I was telling you about the FTA between India and the Eurozone. There's already an FTA under discussion between India and the Eurozone. But thanks to the economic crisis which is going in the Eurozone, this is at the back burners. But it is definitely under discussion for the last couple of years. India is already trying to enter into a FTA, which basically promotes easy trade between the two sets of countries. So India is trying to do that with the Eurozone for the past couple of years. Okay, so let me just see. Okay, so like I said, currency fluctuation or currency rate fluctuation always is a matter of demand and supply. So if you want to talk about currency, let's take the example of rupee versus the dollar. So if the rupee increases or decreases in value against the dollar, it will always be thanks to either the demand and supply of the rupee or the demand and supply of the. Okay, so as I was saying, I was answering the question on currency fluctuations. So I was saying that the currency fluctuation between any two currency will always be due to the demand and supply of the two sets of currencies. So if we are talking about rupee and dollar, for example, the fluctuation of the price or exchange rate of rupee dollar will always be as a result of demand and supply of rupee and the demand and supply of dollar. Now, there are another set of factors which will affect the demand and supply of rupee and which will affect the demand and supply of dollars. We'll go into that when we talk about foreign exchange. Okay, so that is how it works. Malkesh, yes, the more the exports a country does, the more will be the demand of rupee and the more will be the appreciation in the currency. So for example, the example which I gave you earlier, let me just return to my white. So let's say for example, we said that the dollar rupee exchange rate is 60, right? Now, if there's an exporter and he sells that 300 rupee software, he builds an American importer and he raises a bill of $5, right? It will be a bill of $5. Now, when the money flows in, when the dollars come into the Indian market, the Indian exporter will go to his bank and say, please give me rupees because I can't use the dollars in India. So there will be an increase in demand of rupees. And of course, this means that the rupee will go from 60 towards 50. The rupee will gain in strength. This means that the rupee has gained in strength. So exports gain the strength of the rupee, right? So rupee will become stronger because of exports, because the demand for rupees has gone up. Okay, so that is how it works. Yes, Rahil, it is an irony. So it is because of the exporter the rupee gains in strength and the exporter gets hurt the most. So that is the irony. You have recognized it very correctly. Harman, you can follow the banking guide. So there's a banking guide which is printed. I don't remember the name of the publisher, but you can go to any bookshop and ask for the banking guide. It will tell you the very basic information and in fact it will not even tell you updated information about the Indian banking. It will be very important and much more useful if you can search for relevant banking terms on Google. That is much better. Okay. So banking. Hello, can you hear me, guys? Yeah, okay. So there's a banking magazine. You go to any bookshop, okay? Banking Monthly is there, Banking GK is there. All of these magazines will give you your banking digest diet. And whatever you don't understand, you can always check out on Wikipedia and Google. Okay. So sadly, the irony that I was talking about is that it is because of the exporter that the rupee gained in strength and went from 60 towards 50, as you can see on your whiteboard. And when it goes to 50, it is the exporter himself who gets hurt. It is the exporter himself who loses out, and the next bill that he raises, suppose I want to bill the American importer again, I want to make another software for 300 rupees. Now my software will cost $6. So it is because of my transaction, first transaction, that the rupee went from 60 towards 50, and it is me only who got hurt. That's how the irony works. Sadhvi, it will move to 50 because the rupee will gain in demand, right? So the exporter, when he gets his money, he gets his $5 from the American guy, he will go to the bank and demand rupees. And like I told you, if the demand is higher, the price of the rupee will strengthen, right? So that is how it moves towards 50. I didn't say it will go to 50, it will move towards 50. The rupee will grow strong. Let me quickly come to the important topics. I'll come to cooperative banks later, but let me quickly talk about some important rates which I feel are important for you. Okay, this is another important slide. Recently, the RBI has talked about something called payment banks. Okay, where this is a new type of banks which have come into the economy. In fact, they have still not come in. The RBI has just given the guidelines for these banks. They have recently, just about 15 days back, started receiving applications from companies who are interested in making payment banks. Okay. The objective is very simple. People who don't have bank accounts can use these as their first bank account. The purpose of these is only to make payments. These will not be doing your the regular functions that we talked about, borrowers and lending. So they borrow money and lend money. No. So they will just be an institute where if you want to make payments, you can open an account there, and through this bank you can make payments. Okay. The entry capital requirement from a normal bank in India is 500 crores. whereas for a payment bank is only 100 crores, and it is essentially for low income households who require payment services. Okay. They will also be required to keep CRR like the other normal banks, but they cannot hold more than 1 lakh rupees per customer in the savings account or the current account, and they cannot have any lending. They can only lend SLR approved securities. I'll come to SLR and then I'll explain this. Okay. So anybody, even small retailers, somebody who has a Kirana shop, other banks, existing banks, cooperative societies, companies, telecom companies, non-banking financial companies, all can apply and start a payment bank, and the RBI has received quite a number of applications for this. They plan to launch payment banks in the financial year 2015-16. Okay, so this is what payment bank are. This is a very recent development in the Indian financial system. Okay. So this is the last thing that I want to cover today, and I guess the rest of the things will have to move on to the next session. The RBI's monetary policy. So the RBI has various tools like CRR, SLR, repo rate, reverse repo rate, and bank rate. All of these tools are used by the RBI to ensure that the money flow in the economy is regulated. So they want to ensure that the money in the economy is as per what they feel is right. So they can increase or decrease the money flow in the economy with these tools. So NBFC, I'll explain again. NBFC is the non-banking financial companies. These are companies which are financial service organizations but not banks. Okay. So let me explain all these tools. You have something called the base rate. Now base rate is specific by every bank. Base rate is the rate at which or below which banks cannot charge. So let's say the base rate for State Bank of India is 7%. State Bank of India cannot give a loan below 7% rate of interest. So every bank decides its own base rate based on their borrowing cost and lending rates, and they are free to decide this, but they are not allowed to lend money below the base rate. Okay. So they will not, right? The purpose of a base rate is for the general public to know that this bank will not lend below 7%, for example. So the general public will know that, okay, you are lending to me at 8%, your base rate is 7%, which means you are lending to me at your base rate plus 1%. So that's the purpose of a base rate. Okay. Bank rate, this is the rate at which RBI lends money to banks. Okay. And the latest monetary policy which came on 2nd of December 2014, this bank rate today is 9% per annum. Okay. Yeah, I'll come to Daksh, I'll come to repo rate and bank rate. I'll explain the difference between the two. Okay. See, base rate is not high or low for any type of bank. It is based on the borrowing cost of each bank. See, you have to understand that where a bank gets its money from. Every bank gets its money from the public. So people give money to a bank in shape of current account deposits, saving account deposits, FDs and RDs, right? So for example, State Bank of India gets 100 rupees in a saving bank account and 1000 rupees in current accounts, right? So in a current account, on that 1000 rupees, SBI does not have to pay any interest. So that means its borrowing cost is quite low. Versus, let us say, ICICI Bank. ICICI Bank gets 1000 rupees in savings accounts and 100 rupees in current accounts. Now on 1000 rupees, ICICI will have to pay 4%. Whereas on 100 rupees, it has to pay nothing. So the borrowing cost of ICICI is much higher than the borrowing cost of SBI, and therefore their base rates will be different, right? So it depends on the borrowing composition of bank. So it has more borrowings coming in the shape of savings accounts or current accounts or FDs, depends on that. Okay, so let's talk about SLR first, then I'll come to repo rate. So SLR is that percentage of a bank's deposit. So bank borrows money from savings accounts and current accounts. So let's say a bank in all at the end of today, let's say today is the 26th of December. So today when a bank closes its doors, evening 5 o'clock, let's say it has 1 crore rupees in all its accounts, savings accounts, current accounts, FDs, etc. 22% of that 1 crore, a bank has to maintain in government approved securities. This addresses the question which came in earlier, that how, so suppose I give in money and it lends it to somebody else, the bank lends the money to somebody else, and I go to withdraw, where is the bank's got the money? So 22% of the bank, 22% of the money the bank has to keep with itself, yes, for withdrawals, like a safety net, absolutely. It is for the purpose of withdrawals. Okay, so it keeps it in the form of cash, gold, or government approved securities, even treasury bills. This is a daily basis balance. This is a balance which is calculated and maintained on a daily basis. There are some government approved securities, some types of bonds like treasury bills in which every bank can maintain its SLR. So this is to be maintained by them in their own bank as liquidity requirement. That is why it is called the statutory liquidity ratio. Okay. Very similar to SLR is the CRR, the cash reserve ratio. And cash reserve ratio is the amount of money which every bank needs to maintain with RBI. This is checked quarterly. So every bank at the end of a quarter, let's say in my bank I have deposits of 1 crore rupees, savings accounts, current accounts all put together. I need to maintain 4% of that as cash with RBI. Okay, this is called the cash reserve ratio. Currently it is 4%. So SLR rate is increased or decreased by the RBI. Like I was telling you, all of these are used as monetary tools by the RBI. So CRR, SLR, repo, reverse repo, bank rate are all tools used by the RBI to ensure increase or decrease money supply. Okay. So if RBI increases bank rate, that means banks get money at a higher rate as loans from RBI. So therefore RBI is squeezing the supply of money. If the bank rate is reduced, it means that RBI is giving cheaper money to the banking system and more money is flowing in. Yes. Similarly, if the SLR is increased, it means liquidity is being squeezed. More money has to be maintained as the liquidity ratio. That means bank can lend just about 78% today. And if the SLR were to be increased to 25, that means bank can just lend 75 out of 100 rupees. Right? So that is how it works. RBI increases or decreases SLR and the other tools based on its monetary policy. So CRR is the same thing. It can increase or decrease as per the discretion of the RBI. Okay. Then you have the repo rate. So repo rate is the rate at which RBI charges or gives loans to banks for short term. So let's say a bank, like I told you the example, let me use the whiteboard. So let's say in my bank I have 1 crore rupees as deposits. You now know that I have to keep 4 lakhs with the RBI as CRR. You also know that I have to keep 22 lakhs as SLR with myself. Correct? No, these are two separate things. There's nothing inclusive here. These are not common. These are two separate things. So I need to keep 22 lakhs with myself as SLR. Now these are in government approved securities, RBI approved securities. So this includes treasury bills, gold, etc. Like I told you earlier. Against this, so this I'm maintaining with myself. Against this, I can take a loan from RBI. That loan will be given to me at the repo rate. This is the loan rate which RBI gives me a loan against these securities. So a bank can get a loan against these securities at the repo rate. So repo rate is the rate at which RBI gives me money, gives the bank money against the securities which the bank has kept as SLR requirement. Okay, so currently the repo rate is 8%. So how much money I will get or how much money the bank will get as per under the repo rate depends on how much securities I'm keeping as my SLR. Again, so if the RBI increases the repo rate, it means it will give me money more expensive. So again, there's a squeeze. So the RBI increases this rate, that means it is squeezing my money flow. It is squeezing money to the banking sector, right? And reverse repo is the opposite of that. So suppose banks have excess liquidity, bank has more money, bank can give a loan to RBI. Okay, and the loan which, let's say, a State Bank of India gives to RBI, RBI will pay the interest. That interest is called reverse repo. And reverse repo rate is always 1% below the repo rate. So if the repo rate is 8%, reverse repo is 7%. Satya, this is not cheating, yeah. RBI is the regulator. He will always charge more and pay less. Just like a bank charges you more when you take a loan and pays you less when you deposit money. The RBI also has to earn a profit, right? So this reverse rate is always 1% below. So the RBI just has to decide the repo rate, reverse repo, that's automatically decided. So banks give money to RBI when they have excess money. So instead of keeping the money idle, so let's say I have taken 100 rupees as a borrowing. So let's say from the public I got 100 rupees as borrowing, but I didn't find somebody to loan it to. I loaned out just 50. I could not find a borrower for taking the rest of the money. So therefore I can keep it with RBI where it will earn some interest. Right? So these are the tools of the monetary policy. Okay, and then finally you have, okay, there's one more tool which I want to discuss, which is the marginal standing facility. So the marginal standing facility is the rate which is charged by RBI. It is also a rate which is charged by RBI for giving a loan to banks, but it is charged over and above when you don't have securities. So when I said the bank keeps securities under SLR, it takes a loan from the RBI against that. So let's say my SLR securities are finished. I've already taken a loan against that, but I want more money. RBI will give it to me for a short tenure under the MSF facility. Okay, and this is the most expensive loan. Currently it is close to 10% rate of interest. Yeah, so the LAF is also called the marginal standing facility, liquidity adjustment facility. Okay, MSF and LAF are the same component. Guys, are these tools clear? Any questions on any of these tools? Bank rate, like I told you, is the rate at which RBI lends to bank. This is not against SLR denominated securities. This is RBI loans to banks. This may not be any security at all. Liquidity adjustment facility, LAF. MSF is the marginal standing facility. Okay, it is the rate at which RBI lends money when these SLR securities are over, when a bank lends more money than the SLR securities it has. Yes, bank rate is for the long-term loans, Raja. Yes. Okay, so RBI is actually, if you look at it, RBI does not report profits actually at all. RBI with its profits goes into welfare activities for the financial sector. So it will try and set up, like I told you, banks in the rural areas, the local area banks. It will try to fund them. It will make funding easier for them. So RBI invests it further in financial welfare activities. It does not report any profits to its owners. So yeah, so if you look at this, if you look at all the rates in which RBI is giving a loan to the banking sector, the effect of raising these rates is that loans become more expensive for the banks and liquidity is squeezed. Whereas the rates like the reverse repo, when the RBI is taking a loan, if the RBI increases that rate, it means it is supplying more money into the banking sector. Okay. So yes, obviously all these rates affect the money supply in the economy and consequently the inflation in the economy. All of these rates affect inflation. The source of income, Nikhil, for payment banks will be charges. Again, commission or fees, which they will charge for the payment or remittance services. So they will take a fees or a commission for that. Okay, so CRR again. Okay, so CRR is the cash reserve ratio. It is currently 4%. It is the portion of a bank's deposits that it has to maintain with RBI as security. Okay, this is not to be maintained with the bank with itself. It is to be maintained with RBI. Okay. And Rakesh, regarding inflation, like I told earlier, I will be talking about inflation and related concepts in detail in the discussion on the Indian economy. It's a separate session. Please do attend that. We will talk about it there. See, inflation, the point is very simple. Yeah. In case the RBI wants more money in the economy, again, remember demand and supply. If the RBI allows more money in the economy, it gives cheaper loans to banks, more money will flow into the economy, then people will buy more products at higher prices, inflation will go up. So if RBI decreases interest rates, inflation is likely to rise as a result of that. In case RBI wants to bring inflation down, it will squeeze the money out of the economy, right? So it will increase interest rates to reduce inflation. So that's how it has been working. No, Raja, interest is not paid on CRR. RBI does not pay anything on CRR. Any other question, guys? Okay, guys, so thank you. We will close the session here today, and I hope to see you the next time.